Hey, what's up, stock compounders? Brad here. So Jake Bauman this morning asked me, "Hey, would you do a Q&A? I've got a couple burning questions for you." And so I thought, yeah, sure. Let's do a Q&A tonight, right now. So I threw this community post up. I got 14 comments on it. Some great questions in here. So let's dive right in, guys. We're going to skip this first one. That's ridiculous. So Jake asks, okay, and Jake is treating this kind of like a Berkshire Hathaway annual meeting where he's asking a double question. I feel like Warren Buffett here. So let's check these out. Do you attempt to figure out a firm's cost of capital? I think a great franchise business is one that is able to earn above its cost of capital while maintaining a competitive advantage. So you guys can read through this. I do not attempt to calculate the precise cost of capital for a firm, the cost of debt and the cost of equity using the weighted average cost of capital. This is a great question for Aswath Damadran, who teaches business valuation at New York University Stern. For me, I tend to go with this latter part here, a standard 15% discount rate, which is Phil Town style. I like that. It's very conservative. And to me, the kind of illusion of accuracy when it comes to, precisely calculating a cost of capital, it's just not worth the effort to me. I'd rather just be conservative with my discount rate. The second question, I do have time to answer it. Thank you for saying that. What are your thoughts on investing in a failing business that is offering preferred shares at a preferred liquidation price that is significantly higher than the market price? By buying into the preferred shares, you are getting another layer of protection. But do you think it is still worth it if the business is absolutely terrible? Right. So the way I would answer that is you've got to look at the assets and you've got to compare it to the debt, right? And not just the assets on the balance sheet. You've got to look at what can those assets actually be liquidated for in a fire sale. If the company had to liquidate them, had to sell them off quickly, what could it get for those assets? And then after paying off all of the debt, what's left over? Right? And that's typically going to go to the preferred shareholders who are going to get paid off before the common shareholders. But there's another important piece here, very important piece, and that's this. Management isn't necessarily going to be incentivized to sell off all the assets, pay off the debt, and then distribute the rest to the shareholders. Many times, management doesn't have significant skin in the game in terms of equity ownership, right? They collect a paycheck. They get stock options, right? But even more so than stock options, they get that paycheck, and that's really why they're working at that company. Not to build the business for the shareholders, but to collect the paycheck. So if I'm management and I'm collecting a paycheck, I want to keep the business going as long as possible so I continue to collect that paycheck. And the problem with that is I may try to squeeze all of the value that I can out of those assets rather than liquidating them to benefit the shareholders. So you've really got to understand how management is financially incentivized if you're going to do a play like this. I'm less and less interested in plays like this because, like Pabrai, I'm kind of following him into finding these long-term compounders, right? These great businesses that the market isn't necessarily seeing as great yet. So finding the compounders before everyone knows that they're compounders. That's kind of the holy grail right now. So I'm less interested in the 50-cent dollar bills, the cigar butts, much more interested in these great businesses that I can buy and I can just leave my money there for decades. That's really what I'm after at this point. But, if you have a great arbitrage opportunity, where you can double or triple your money in a fairly short amount of time, still could be worth looking at. But like I said before, that's how I would go about thinking about that, Jake. Thank you for your questions. Mike Geo. Tobias Carlyle said in Acquirer's Multiple that there are companies that occasionally break the rule in terms of mean reversion and keep going up despite being overvalued. Can you think of an example where the opposite is true in terms of a company that was grossly undervalued and continued to plummet? Absolutely. And the key here for me, when you value a company, so much of that is based on your assumptions, right, about what's going to play out into the future. I mean, that's the way I do it, a discounted cash flow valuation. That's the value of the company, the future cash flows discounted back to today. But nobody knows what the future cash flows are going to be. A lot of people look at what have the past cash flows been? How is this company likely to grow over the next 5-10 years? And just kind of project those out and then discount them back. But, so take Sears, for example. Okay, I've been thinking a lot about Seritage growth properties. So Sears, you could argue going back 10 years, Sears was undervalued. It's all about how you're looking at that company, what you're projecting going forward. So you could have come up with a valuation that was higher than the current price, and of course it continued to plummet, right? Sears is no longer in the conversation in terms of businesses that are doing anything. I'm pretty sure Sears has completely disappeared by now, completely bankrupt. So that's the key. Valuation is not a science, right? It's not a strict science. If it was a strict science, everything would always be efficiently priced, right? There would be no mispricings. There would be no value investors. That's how I would answer that. Great book, by the way, Acquirer's Multiple, highly recommended. Eric, I'm not going to try to pronounce your last name. If you're looking to expand your circle of competence, what are your first steps? Even if it's just a quick jaunt outside your circle, do you have any resources when you're doing initial industry/sector research? So expanding circle of competence. Circle of competence, I don't really like that phrasing of it. It's really, what do you know, right? What do you know? And I find the things that are easiest for people to know are the things that you're curious about, right? That's what motivates you to dive in, to do the work, to fill in those holes of what you don't know with, knowing. So if you want to expand your circle of competence, kind of, feel into what you're curious about and then go there, right? Learn about those companies. And as you learn about those companies, if you're interested in them, you'll want to learn about the space that those companies are operating in, what industry, what sector, and how it all fits together, right? So you start with what are you really curious about, and you kind of expand outward, and that's how the circle expands in my experience. But I don't know why, you just want to expand your circle of competence for the sake of expanding it. It's really driven by, I want to know more about this particular thing. So I'm going to learn about it. And as I learn about it, I'm going to have more and more questions. And I'm going to figure out the answers to those questions. So let curiosity guide you. And that's naturally going to expand your circle. Brian, you, like many of us, clone various investors. Yes, I'm a very proud cloner. What do you do when there is conflicting stances on a stock? GrafTech, for example, Pabrai sold for a loss. Magic Formula had it as a buy. As of today, it looks like Magic Formula was correct. How do you determine which investor you are going to follow on a particular trade? So, a couple things I want to share here. In terms of which investors I follow, I kind of have a hierarchy of investors that I weigh more strongly. Pabrai is pretty close to the top. Li Lu, I would say, is at the top. Okay, if something, if there's a new buy from Li Lu, that's the first thing I'm looking at. Pabrai is, close behind. And there's a number of others. You can look at the free lunch portfolio, look at some of the investors that Monish Pabrai clones for that. But I do kind of have a hierarchy in my mind of, say my favorite investor does this, a couple down the list maybe has just sold out of that position. That's going to factor in. I'm going to get curious about that. Why did this investor sell while this investor was buying? But certainly there's a weighting where the higher up, I'm going to treat those buy signals more strongly. The other thing I want to talk about here, so here it says, as of today, it looks like magic formula was correct. Now, just because a certain outcome happens, like GraphTech goes up 50% since maybe the low, or since Pabrai got out, that does not mean that outcome was destined to happen, okay? In the world of investing, we're dealing with probabilities, okay? And the best investors are really good at weighting those probabilities. How likely are these outcomes to happen? And when the positive outcomes are much more likely to happen, that's usually when the chips get moved in, right? That's when the bets happen. But it's no guarantee that probable outcome is going to be the outcome that actually happens, okay? This is the game of investing. It's possible that, there's a 5% chance of failure for the company, right? And that's what actually happens. But we can't know that, that's going to happen only 1 out of 20 times, right? Because that's what we see happen. We think, that was destined to happen. Where did I go wrong on this investment? But that's just not how investing works. That's not how probability distributions work. So, I don't look at it as the magic formula was correct. Pabrai was wrong, okay? Pabrai made the best decision he could based on the information that he had available. Just so happened the stock has gone up since then. Were there things Pabrai could have seen that could have made him hold on instead of selling? Maybe. We all have room to grow as investors. So it's not like Pabrai did, we can't say he did the right thing. We can't say he did the wrong thing, okay? He was looking at what is the probability or what is the risk reward now based on this pandemic that just happened? And what are my opportunity costs? What other investments do I have available, right? We don't really know what he had available. So even if it went up 50%, maybe that was still the right decision, right? If he had known it was going to go up 50%, because maybe he had another opportunity that was highly likely to go up, a double or a 3x or a 5x. So, it's complicated, but it's a great question, and there's a lot of juicy things to digest there. Ravi asks, gurus have a problem with deploying hundreds of millions or billions, so they need to look into big market cap companies. Do you think we, the small investors, should spend more time looking into the micro, small caps for our portfolio rather than cloning big company portfolio of Pabrai and the likes? That's what gurus did when they started, no? It's a great question. It's something I've been thinking a lot about. Let's go into a little bit with Pabrai. So Pabrai right now manages somewhere around $500 million. It might be 600 million, whatever. It's somewhere around $500 million. So based on that, if he wants to make a 10% bet, which is often, what Pabrai does in his portfolio, he's looking to put $50 million into a company. Now, say he doesn't want to own more than 10% of the company, right? Because then you've got, these disclosures you've got to file. It's a little bit of a hassle. And if you're investing more than 10% in a company, chances are all of your buying activity, if you need to buy 10% or more of the shares outstanding, The just you building your position in that company is perhaps going to significantly move the share price upward, which isn't fun when you're trying to establish a position. So, you know, he wants to deploy 50 million, let's say, in a company. So, and he doesn't want more than 10%. So he's looking at companies, say, have a 500 million market cap or higher, okay? Now, a 500 million market cap company is not a large cap company. It's not a big company. 500 million is small cap, maybe even, I don't think it's micro cap. I would say it's small cap, okay? Now, if you look at Chris Meyer's book, 100 Baggers, stocks that return 100 to 1 and how to find them. Chris Meyer basically collected 365 stocks between, I think it was like 1965 and 2015. It was like 50 years, 365 stocks. Now, at the beginning of the period where these 100 baggers were tracked, the average size of a 100 bagger was about 500 million market cap, okay? So you don't need to go super small to get these great long-term compounders. And, you know, so if you're looking at 500 million, you know, I don't think you need to get too much smaller than that to get these great returns. And a lot of super investors can buy that, can buy into those companies. So, you know, I think when Pabrai was buying into Seritage, it was below 500 million market cap. Yeah, just shy, maybe 400 million market cap for Seritage. So I don't think this is as much of an issue as a lot of investors think. We can still clone big investors and find these small cap opportunities. Get the best of both worlds, in a sense. Jack Duffley, my buddy Jack, thoughts on the political climate in the U.S., stimulus, the Fed, and if it's affecting your investing approach. It's not. Well, let me sit with that for a second. I'm concerned about the U.S. dollar. I'm concerned about inflation. I'm concerned about the U.S. dollar no longer being the global reserve currency. So those are some things I've been thinking about. You know, Sam Zell talked about this in a recent interview, how he thinks as soon as 10 or 15 years, the U.S. dollar may lose its standing as the global reserve currency. And that's definitely going to have impacts. But, you know, I haven't fully digested, you know, how all this stuff plays out. So it's not really affecting my investment process at the moment, but it's definitely on my radar. And it's something I'm sure I'm going to be digging deeper into over the next couple of years. And I'm curious to hear from you guys if you have thoughts on this. All the, you know, printing money, you know, how you're kind of accounting for that, how you're kind of hedging against that in your portfolio. I know there's a lot of people loading up on gold, perhaps loading up on Bitcoin as a hedge. I haven't quite gone there yet, but you know, I'm not opposed to it. Rudra, when will SRG become a 100 bagger? I don't know if it will become a 100 bagger. My main investment thesis around SRG is based on the assets that they own, some of the premier assets in very desirable locations. I feel pretty comfortable being protected to the downside. I have much less of a sense of what the upside could be. But we're going to hang on. We're going to hang on and find out. So, you know, I'm planning on holding that 5-10 years. I know, you know, Monish Pabrai recently shared that, you know, he's looking 5 to 15 years, like somewhere in there. We're going to decide what to do with this thing. So it's a good question. When will it become a 100 bagger? You know, nobody knows. I hope it becomes a 100 bagger. And if it does become a 100 bagger, I hope that I have the patience to hold on to it for 20, 30 years, through all the ups and downs. So hopefully I'm smart enough to do that. What are your thoughts on diversification versus concentration? How many companies are you typically holding? Personally, I'm very concentrated with only 4 positions. I target around 5 to 12. Thanks for the question, Frank, my Aussie friend, Frank. So I'm pretty concentrated at this point. I really want about 5 high conviction bets. I really have 2 right now, so I have cash kind of piling up in my portfolio. You guys probably know I have Micron. It's done incredibly well since I bought it at 34. And I have no interest. I'm not even thinking about selling at this point. And then Seritage, which I'm up maybe 40% since I bought sometime in the summer of 2020. So I'd like to have 5, but I'm having a really hard time finding compelling investment ideas right now. So I only have 2. And of course, I'm also doing the test portfolio with the magic formula, which has been a lot of fun. That's kept me busy as I kind of wait for these great opportunities to come along. And hopefully, I'm hoping we get another market dip like what we had in March. I will be much more prepared this time to take action when these companies get down into my buy zone, if that comes around again. At least it's easy to say that. Hopefully you guys hold me accountable for that. I'm sure you will. I'm not even going to try to say that. Pronounce your name. I apologize. Do you think Micron is a long-term compounder? Pabrai seems to think that Micron is a long-term compounder. I'm not smart enough to be able to analyze the business of Micron and decide if it's a long-term compounder. But if Pabrai is bullish on it being a compounder, I am as well. That's my shameless cloning nature. But kind of the simple thesis for Micron, it's kind of a pick and shovels play on all of these industries that are set to boom, that need to be able to crunch an exponentially larger amount of data. Okay? There's a number of industries that are right at the cusp of taking off. So I think Micron is in a great position to benefit from all of that growth. Mitch, where do you see Micron going forward, and at what do you feel its intrinsic value to be? I think with a long-term compounder like Micron, which is how I'm seeing it, I don't really care so much about intrinsic value. Monish Pabrai shared something interesting. He had this conversation with Charlie Munger not too long ago about these compounders and at what point do you sell, right? And they were talking about Costco. And Costco is pretty richly valued right now. I don't know if it's 40 times earnings or what it is, but I'm pretty sure it's higher than it's ever been. But Charlie, he has no interest in selling. And this is something that he can't rationally justify, right? Value investors, typically they have a value for a company, for a share. And when price hits that, they sell. That's kind of the line of thinking, typically for value investing. But when you get a great business, right, that can grow earnings, right, that can compound year after year, the business, the intrinsic value framework for thinking about a company, it's a bit short-sighted. So that's kind of where I'm at with Micron. I don't know what its intrinsic value is. My plan is to really hold on until Pabrai sells, right? I'm doing a strict cloner play with this. When he sells, that's my signal to sell. And I don't even know if that's true, guys, because Micron, I should say Pabrai, he's gotten out of some great businesses, right? Of course, Ferrari he sold, Moutai, he owned Google at one point. He's been in and out of some great businesses. So if I see that Pabrai has sold Micron, that's not necessarily an automatic sell for me. I've got to really kind of dig in to the current story with Micron at that time. And I've really got to be convinced that the story is broken, that it's no longer a long-term compounder. And I do have quite a bit of trust that Pabrai will make a good judgment at that point if he does decide to sell. But I also don't want to just follow any biases that Pabrai might have that might cause him to sell at a time that's not necessarily the best decision. I really like the coffee can approach for these great businesses. So maybe Micron, maybe I'll decide it's just going in my coffee can, and I'm not going to look at it for 20 or 30 years. We'll see what happens with Micron. That was a long-winded answer. Sorry, Mitch. Akil, Brad, can you suggest some sources for articles about companies? I have recently started using Seeking Alpha, which has some good articles. Any other you may recommend? So I don't use Seeking Alpha. In terms of articles, so the sources I really like for digging into companies, I really like Value Investors Club. It's free. There's a delay, but I'm used to having a delay. Looking at 13F filings, there's always a month and a half delay from the end of the quarter. So I don't have a huge problem with the delay. Value Investors Club, Corner of Berkshire and Fairfax is a message board out of Canada. It's $30, I think, per year. Might be $30 lifetime. I don't even know. It was so low. It's just like, here you go. Here's 23 US dollars, 30 Canadian dollars. But it's so good. It is so good, guys. It's really how I learned about SPACs and how to play them in a way where you have this really strong upside potential with very limited downside risk. And there's just so many smart investors in there. It's really a community that formed out of Berkshire, shareholders of Berkshire and shareholders of Fairfax. So those are my big two, Value Investors Club and Corner of Berkshire and Fairfax. Yeah, great resources. Last one, will you make a video about spin-offs? It could be great. That's true, Jose. It could be. Spin-offs, I made a couple videos about spin-offs. Some of you probably saw those maybe a month or two ago. I don't know. I have a 3-month-old. Time is completely distorted. But, honestly, it's not really a place I'm super excited to look right now, the spin-off arena. It seems like it's gotten a lot more attention since Joel Greenblatt wrote his book, You Can Be a Stock Market Genius. So it's not a super compelling corner of the market to look, especially now that I'm focusing on these long-term compounders. It's not to say there couldn't be long-term compounders that are the result of a spin-off. But Pabrai had spin-offs as one of the 3 buckets in his free lunch portfolio up until, a month ago. And now he no longer has spin-offs in the free lunch portfolio. So, that's a bit of a signal to me. Okay, maybe Pabrai doesn't see a huge opportunity here looking in this pond of spin-offs. Now he's focusing on spawners. So, again, I'm not super intrigued by that area of the market at this point. I'm sure there are opportunities there. It's just I only have so much time, and I'm more interested right now in the cloning approach. Looking at some of these climate change investments, decarbonization. So there's areas that I'm much more curious about and excited about than looking at spinoffs. So, but with that said, if any of you guys are really interested in spinoffs and you want to come up with an outline for a video and you send it over to me and I'm like, wow, this is really interesting, I will make a video about that and I'll add my 2 cents and it'll be fantastic. So it could be great, it could be fantastic. We don't know. So there's an idea for you guys. If you ever want me to make a video on something and you really want to encourage me to do so, send me the work you've done on it, and I'll take a look at that and I'll decide, all right, can I add value here or not? And if I can, I'll just move on. But that's kind of my piece on that. This was great, guys. I feel like this was the first Q&A, aside from the recent one I did with Karan, where I've gotten a lot of questions directly from my community. So it's very exciting to me to be able to answer your guys' questions directly. So we're going to do a lot more of these in the future. Thanks to everyone who asked a question. Thank you all for your continued support of my channel, hitting those like buttons, leaving the comments, subscribing, telling your friends. It's been an awesome journey so far, and there's fantastic things to come. I can feel it. So with that said, I will leave you guys until the next video. Take care.